Index funds are famous for building long-term wealth, but how does passive indexing consistently beat highly paid Wall Street experts? For decades, investors paid expensive stock pickers to actively guess which companies would perform best. To see why that fails, let's track a hypothetical $100,000 portfolio over 20 years. Instead of guessing the winners, you can buy tiny, permanent pieces of the 500 biggest U.S. companies to capture the overall market's growth. This baseline bucket is an S&P 500 index fund. Because this passive approach just blindly copies the market, you'd think it would deliver much lower returns than a professional. But professionals charge around a 1% annual fee for their constant trading. Meanwhile, the passive fund charges almost zero for just sitting there. Over 20 years, that 1% doesn't just cost you the initial fee, it destroys the future interest that money would have earned on itself. This is a snowballing mathematical force known as compound growth. Because the passive fund doesn't leak money to high fees, those savings stay in the portfolio to generate their own returns year after year. And that original $100,000 portfolio we started with 20 years ago, by buying the market and doing nothing, it out-earns the experts simply by keeping all its own growth.